Welcome back, guys. Before we went on our break, we were busy looking at your production cost statement, and we've already completed our direct material cost calculation, our direct labor cost calculation, and now we're going to move on to our factory overhead cost calculation. So let's get started with factory overheads. Right, remember people, factory overhead costs, this simply refers to your other factory expenses that the business is going to incur while they're manufacturing shoes. So we've got factory overhead costs. The first item is the salary of the foreman. So let's go to our question. And we're looking at the summary of transactions. There we go. Summary of transactions. Under salaries, we've got factory foreman and his salary an amount of 150,000. There was no additional adjustments in terms of the factory foreman. So let's take that amount through. So we've got salary for the factory foreman an amount of 150,000. Then the next cost is our consumable stores for the factory. And remember here, the example that I gave you guys was an item such as glue could be considered to be consumable stores. It's an indirect material that is used in the making of the product itself. Now, in order for me to calculate my consumable stores that was used in terms of the making of the shoes, I'm going to give you guys a very simple formula that will work with more or less almost any question. The formula that you should use is take your opening balance for your consumable stores, add purchases for the year, additional consumable stores that you bought during the year, add any carriage that you might have paid in terms of transporting this consumable stores, and then finally subtract your closing balance or your closing stock for consumable stores. I'm going to say that one more time, guys. I'm going to take my opening balance for consumables. I'm going to add my purchases. I'm going to add any carriage that I might have paid, and I'm going to subtract my closing stock or my closing balance. Right, let's start with this calculation. Let's start firstly with your opening balance. So back to the question, and we're looking at information at the top. My consumable stores stock opening balance, I started off with 6,000 Rand worth of stock at the beginning of the year. So let's bring that through. So consumable stores opening balance, guys, I just want to change the color of the pen here. So open brackets, 6,000. To this, I'm now going to add my purchases. So back to my info, summary of transactions. Consumable stores purchased for the factory, 43,000. So let's take that through. I've purchased stock or consumables for an amount of 43,000. Then let's now look at carriage on purchase for consumable stores. Are there any carriage? I don't think we came across any, but let's quickly check. So I've just got carriage and purchases of raw materials, but none for my consumables. So carriage on purchase, there isn't any, which leaves me with my closing stock. So let's go to our closing stock info. Closing balance at the end of the year. Consumable stores stock, leftover stock, in other words, stock that was not used, 7,000. So let's take that through, an amount of 7,000. And remember, my closing stock I need to subtract, so minus 7,000. Right, let's get our calculators out and let's calculate how much of consumable stores was used. So I'm starting with 6,000, I'm adding 43,000, and then I am subtracting that amount of 7,000 to give me my consumable stores that was used, 42,000. So let's take that amount through, 42,000. Okay, now remember guys, a calculation like this, you've got to show it in brackets because it obviously carries lots and lots of marks, close to 4 marks for this calculation. Right, next item that falls under my factory overhead costs is my depreciation. So your depreciation calculation, people, you've done this a million times when you're doing an income statement. Not a difficult calculation at all. Let's just go through it in terms of your depreciation on your factory plant and equipment. So let's go to our info. Okay, my information at the beginning of the year, there we go. Factory plant and equipment at cost, 2,225,000. Then I've got accumulated depreciation on factory plant and equipment, 450,000. Okay, so I'm obviously going to need these figures. Let's just read on. Then during the year, factory plant and equipment was purchased, and it was purchased on the 1st of September, 250,000. So I'm going to need this bit of info as well. And then additional information. Let's find it. There we go. Depreciation on factory plant and equipment must be brought into account at 10% per annum according to the diminishing balance method. Remember guys, diminishing balance method, you learned this in grade 10, is my cost minus my accumulated depreciation. Right, taking all of this information into account, let's now calculate our depreciation. So let's go back to our answer sheet and let me just extend the page. Okay, my depreciation. I obviously have old factory equipment as well as new factory equipment that was purchased. Let's start with the calculation for my old factory equipment. So again, guys, I'm going back to the info. Okay, so my old factory equipment, in other words, before I purchased, my factory plant and equipment had a cost of 2,225,000, accumulated depreciation 450,000. So let's get those calculators out and let's calculate your depreciation. Remember, we're taking cost minus accumulated depreciation. Okay. We're going to subtract our accumulated depreciation of 450,000 to get a carrying value of 1,775,000. We are then going to times this by 10% because we're depreciating by 10% to get a depreciation amount of 177,500. So let's take that through. Okay, so our depreciation 177,500. Right, depreciation on the new equipment that was purchased. I'm just going to quickly, guys, plot a timeline. Financial year starts on the 1st of March 2009, ended on the 28th of Feb 2010. Let's just quickly go to our info and check when did we purchase this additional equipment. So we're going to additional information. There we go, additional information. It was purchased on, no guys, not additional info, summary of transactions was what I should go to. Okay, so factory plant and equipment purchased on the 1st of September 2009 for 250,000. Okay, so this was purchased. Let's just change the color of the pen there, somewhere here. 1st September 2009, which means because it was purchased on the 1st of September, we've only used this equipment for this time frame. And if we count, guys, 1st of September to the end of Feb is a time frame of 6 months. So we only can depreciate this new equipment for 6 months. So let's take our cost. Our cost was an amount of, guys, I have to go back to the question. Our cost, 250,000. Okay, so we're taking the cost, 250,000, times my rate, which is 10%, times the number of months I need to depreciate, which is for 6 months, 6 over 12, to give me, again, my calculator. So 250,000 times 10%. Okay, and it's for 6 months. I'm dividing it by 2 to get depreciation on this new equipment, 12,500. So let's write that down, 12,500. Right, guys, so there's our depreciation. Remember, try and show your calculations in brackets. I'm going to use this amount, 177,500, and I'm going to add my 12,500. You guys have done this a million times, I'm sure, when you did an income statement. So I really don't want to spend too much of time on this. So let's go to depreciation, open brackets. We are adding 177,500 plus my 12,500. Okay, so my total depreciation plus 177,500. If I just add up those two amounts, guys, I'm getting my total depreciation 190,000. So let's fill that in, 190,000. Again, people, bracket work, absolutely important, because if I've made a mistake in terms of my 12,500, I can be assured of getting 1 mark at least for my 177,500. Right, back to our factory overhead costs. So we've looked at 3 costs thus far. Let's now look at water and electricity. So again, going back to your question, your water and electricity was a total of 163,000, but then we've got additional information. So we've got additional info, D, okay, that tells us an amount of 4,200 Rand was still outstanding on the water and electricity account. Remember, guys, still outstanding. This is obviously an accrued expense. And you've learnt accrued expenses form part of the financial year and therefore needs to be included. Included meaning I need to add on this 4,200 Rand to my water and electricity. 60% of all the water and electricity was used in the factory. And remember, I'm trying to calculate what was used by the factory itself. So I've got there 60% was used in the factory. So what I'm going to do with this adjustment, guys, I'm going to first add on my 4,200 and then I'm going to calculate 60% on that total to take it to my factory overheads as my expense for water and electricity. So let's do that, and we're going to actually, I'm going to use this bit of space here to do the calculation. Okay, so my water and electricity is an amount of 163,000. So let's just take that through. Okay, so water and electricity, 163,000. I now must include my accrued expense. So I'm adding on 4,200, and then only 60% of the total cost was used in the factory, and that's what I'm trying to calculate. So I'm going to multiply this then by 60%. So let's do that. Let's get our calculators out. Okay, so we've got your water and electricity, an amount of 163,000. We are then adding our 4,200. Okay, and then we're going to calculate 60% to get an amount of 100,320 was that portion of the expense that was obviously for the factory. So let's take that through. Okay, so my water and electricity account. Again, guys, make sure you show your calculations in brackets, an amount of 100,320. Okay, right, very last item that's going to fall under factory overhead cost is my sundry expenses. And I think this was very straightforward. Let's go to your summary of transactions. You've got sundry expenses for the factory, an amount of 194,680. So this amount here, people. All I'm doing is taking this amount through because there was no adjustment or additional information. So let's take it through. My sundry expenses, an amount of 194,680. Okay, guys. Right, almost done with my factory overhead costs. All I've got to do now is add up. I need to total. So let's get those calculators out. So we've got 150,000 plus my 42,000 plus 190,000. And then I'm adding 100,320. And then finally my sundry expenses, which was 194,680. to give me my factory overheads, an amount of 677,000. So let's fill that in. Factory overheads, 677,000. Right, guys, I've got my three costs that I spoke about right at the beginning of the session. I've got my direct material cost, I've got my direct labor cost, and I've got my factory overheads. So now I can calculate what was my total production cost. In other words, I now need to complete my production cost statement. So let's do that. That is the next bit of our question. 1.3, prepare the production cost statement for the year ended 28th Feb 2010. Right, my production cost statement, guys, it's just a matter of now filling in figures. So we're starting off with my direct material cost. The calculation was previously done, so let's go back to that calculation. Your direct material cost was calculated at 952,700. So let's take that through. Okay, your direct material cost, an amount of 952,700. Right, next item is my direct labor cost. Again, I've done this note. So let's go to the note and let's pick up the figure that we've calculated. Your direct labor cost was calculated at 737,300. So again, simply taking it through to your production cost statement, direct labor cost, an amount of 737,300. Direct material cost plus my direct labor cost is what we call our prime cost. Prime cost, obviously coming from the word primary cost. Primary meaning what went into the actual making of the product. Your direct materials as well as the people that manufactured the product itself, your direct labor. So prime cost, people, is simply another word for your direct cost. Okay, so all we're doing is we are adding up these two direct costs. So let's get our calculators out. Okay, so our direct cost or our prime cost, 952,700. We are then adding 737,300 to get a prime cost of 1,690,000. So let's enter that in. Okay, prime cost, an amount of 1,690,000. 90,000. Right, next item is our factory overhead costs. That's what we've just calculated in the previous question. So let's go back to that. Our factory overhead cost was an amount of 677,000. So again, simply taking it through to your production cost statement, factory overhead cost, an amount of 677,000. Okay, right, we can now calculate our total cost of production. Total cost of production, people, is simply our prime cost plus our factory overhead cost, or it's our direct material cost plus our direct labor cost plus our factory overhead costs. Those three costs that I spoke about right at the beginning. So let's now add, or let's calculate our total cost of production. Okay, we've got our prime costs calculated already. So we're simply adding on 677,000 to get our total cost of production, 2,367,000. So let's fill that in. Just want to change the color of my pen there. We are going to record our amount of 2,367,000. Okay, right, almost done. We now have our work in progress at the beginning of the year, which we're going to add. Work in progress at the end of the year, which we're going to subtract, and that will give us our total cost of production of finished goods for the year. So let's start with work in progress at the beginning of the year. We're going to our info, and it's right at the top, opening balances. Work in progress stock at the beginning of the year was 158,000. So let's take that amount through. So we've got our work in progress at the beginning of the year, 158,000. Let's just check that, people. Okay, 158,000, correct. Okay, so let's add our work in progress at the beginning of the year. So plus 158,000 to give us an amount of 2,525,000. So let's enter that in. So we've got an amount of 2,525,000. Right, we now need to subtract our work in progress at the end of the year. So let's now go to our information. Work in progress at the end of the year. Okay, there we go. Closing balances on the 28th of Feb, in other words, at the end of the year, work in progress stock, and it's not given to us. Okay, don't you guys hate that when something is not given to you? Right, remember, people, if it's not given to you, then we obviously need to think a bit, think out of the box. How am I going to calculate my work in progress stock at the end of the year? So let's now go to our answer sheet, and let's just try and work this out. So we've got work in progress at the end of the year, which is not given to us. I'm going to call this X. It's unknown, which means my total cost of production of finished goods, I also can't calculate this. So I've got two X's. Whenever you've got two unknowns, guys, remember, you need to try and calculate one of the unknowns. So if I can calculate my total cost of production of finished goods, I can then easily calculate my work in progress at the end of the year. Now let's go to the last bit of information that was given to us in the question that we haven't used thus far. Okay, so back to our question. The last bit of information, people, because we've used everything except for the following. Okay, information F. During the year, 20,000 pairs of shoes were manufactured. So according to this info, we've manufactured 20,000 pairs of shoes. The shoes are sold at a markup of 65% on cost, and then I've got the shoes are sold at 198 Rand per pair. Right, so taking this information into account, how can I use this information? I know that I've manufactured, or the business has manufactured, 20,000 pairs of shoes. We are trying to calculate what is the total cost of production for the year, the cost of production in terms of your finished goods. So this is my units that were manufactured. I'm trying to calculate the actual cost, the Rand value. So if I take my units and I multiply this by my cost price, in other words, what did it cost me to manufacture one pair of shoe, I will then get my total cost of my finished goods, the total cost of shoes that were manufactured. So the key to this, grade 12s, is let's see whether we can calculate our cost price. From the information that is given to me, I am given selling price per unit, which is 198 Rand, and I'm given a markup of 65%, which means I can obviously calculate my cost price. Yes, I'm going back to your grade 8 accounting, calculation of cost price. So let's do that. Let's calculate your cost price. Cost price is equal to, remember you did this in grade 8, selling price times 100 divided by 100 plus my markup. So if I take 100 plus 65, I'm dividing by 165. So let's get our calculators out. Let's work out that cost price. Okay, so we've got a selling price of 198 Rand. We're multiplying this by 100, and we're dividing this by 165 to get a cost price, people, of 120 Rand. That's how much it costs the business to manufacture one pair of shoe. That is the cost price. So we've got our cost price. Let's just extend that page there as an amount of 120 Rand. Right, all I have to do now, my 20,000 units times my cost price of 120 Rand will give me my total cost of finished goods. So let's get our calculators out again. And on our calculator, all we're doing, guys, is taking 20,000 times your cost price. So let's just clear that. 20,000 times cost price, 120 Rand, to give us a total of 2,400,000. Okay, so let's just write that down. We're getting an amount of 2,400,000. And remember, guys, this is my total cost of finished goods. So let's go back to our answer sheet. Total cost of production of finished goods was what we just calculated. Show your calculations in brackets. We took the 20,000, we multiplied it by 120 Rand to get, let's just erase this X quickly, to get an amount of 2,400,000. Right, all I have now, grade 12s, is 1x, and it's very simple for me to calculate this. This is the value of your finished goods. Okay, the total cost of production of finished goods. This is obviously your, after I added my work in progress at the beginning of the year. So all I'm doing, people, is I'm subtracting the two to work out my work in progress at the end of the year. In other words, goods that still need to be completed. Okay, so let's get our calculators out. Our total value of goods that were in production, 2,525,000. We've obviously completed 2,400,000. which means work in progress at the end of the year still needs to be completed, 125,000. So let's get that X out and let's fill it in, 125,000. And remember, guys, this must be in brackets because it's obviously closing stock still needs to be completed. Okay, people. Right, almost done with this question, guys. We've done the production cost statement. We're now moving on to our calculations where we're going to be looking at break-even cost. So let's move on. Right, our next question. You are provided with unit cost and the break-even point calculated for the past 2 years. So they've given us the break-even point. It's already calculated. And we've got unit cost for the past 2 years. So we've got 2010. I'm just going to remind you guys again, this is the current year. And then 2009 is our previous financial year. Raw material cost per unit from the previous year. Let's start with the previous year. 54,000, sorry, let's say that one more time. 54 Rand and 30 cents. It's now dropped or decreased to 48 Rand and 30 cents. Direct labor cost per unit, it was 51 Rand 70 cents, and we notice it has also decreased, it's also dropped to 37 Rand 38 cents. Our factory overhead cost per unit, this has increased. Let's just look at it in a bit more detail. 2009 it was 30 Rand 25 cents. It has now gone up. It has increased to 34 Rand 32 cents. Now remember guys, if we add up these three costs, we're going to get our total cost or our cost price per unit. And remember, we already calculated that. It came to an amount of 120 Rand. Okay, so we had 48 Rand 30 cents. We are adding 37 Rand 38 cents. And then we are adding 34 Rand 32 cents to get my cost price of 120 Rand, which is obviously the same amount, the same cost price that I previously calculated using the selling price and the markup. Right, next bit of info, my break-even point is given to me. 19,548 units must be manufactured to break even in 2010. 2009, it was 11,300 units. So the break-even point has somehow increased. It's gone up. And then number of units produced, 2009, the business was making or manufacturing 24,000 pairs of shoes. In 2010, it has dropped or it has decreased to 20,000 units. Right, let's go to our questions and let's attempt answering them. The first question on this calculation or on these ratios that were given to us. Explain whether Fatima should be concerned about the break-even point for 2010. Quote figures to support your answer. Right, guys, I mentioned right at the beginning that I'm going to explain break-even point when we get to the actual question. Let's now take some time to recap on break-even. Now, remember, at the point of break-even, the business is not making a profit, nor are they making a loss. They are breaking even. In other words, if we had to put out a formula or write a formula for this, it simply means that at this point of break-even, my income is equal to my expenses. In other words, there is no profit at this point, no profit, nor is there a loss. Income is equal to my expenses. That's what we mean by the point of break-even. Now remember, at the point of break-even, there's obviously no profit, no loss. But the moment the business starts manufacturing above the point of break-even, so if, for example, the point of break-even is 20,000 units, the moment the business starts manufacturing 20,001 unit, it's obviously above break-even point, the business automatically will start making a profit. So the moment, in order for the business to make a profit, they have to exceed the point of break-even. So you've got to exceed your break-even point. If the business, however, is manufacturing at a point that is lower than that break-even point, so if our break-even was calculated at 20,000, and if we are manufacturing 19,999 units, it's one below the point of break-even, we are making a loss. Okay, you guys understand that. It's a simple concept. The moment I manufacture above break-even, I'm making a profit. The moment I manufacture below break-even, I am making a loss. So this question is asking us whether the owner being Fatima, whether she should be concerned about the break-even point for 2010. So let's go to our info above and let's inspect. The break-even point is 19,548 units. The business is producing, number of units produced is 20,000 units. So immediately ask yourself, is this above break-even? Yes, it is. It is above break-even. Anything above break-even means that the business is obviously making a profit. So should Fatima be concerned? The answer is no, guys. She shouldn't be concerned because she's obviously manufacturing more than break-even point. Hence, she will be making a profit. So your answer in this question should be no, she should not be concerned. And the reason being, the business is manufacturing above break-even point. And remember, the question wanted you to quote certain figures. Guys, I know I'm obviously abbreviating here, but I want to try and complete this question. So if we look at the figures that we're going to quote, the break-even point for 2010 is an amount of 19,548 units. So 19,548 units, while the business is producing for 2010 20,000 units, and it's obviously above the point of break-even. So she shouldn't be concerned. Okay. Right, let's move on now to the next question. The next question, they are now asking us, give a possible reason other than price changes for the above or for the change in each of the unit costs provided above. Unit cost, remember guys, we were given raw material unit cost or cost per unit, direct labor cost per unit, and our factory overhead cost in unit. So what they're simply asking us is give a reason for the possible changes from 2009 to 2010. So we've already established that direct material cost per unit decreased, direct labor cost also decreased, factory overhead cost, on the other hand, went up, it increased. So let's now look at a possible reason other than price changes. So we can't give price changes as our reason. Let's start with our raw material cost per unit. It has obviously decreased, and we now need to give a reason as to why it would have decreased. Now remember guys, if I'm going back to my chocolate, okay, back to the Aero chocolate. Milk goes, one of the items that would go into the making of this chocolate would be milk. Now, what would happen if some of the workers spill a bit of milk? In other words, they waste certain raw materials. Obviously, the raw material cost per unit will then increase. It will go up. But if they use it efficiently, there is absolutely no wastage. So if, for example, we're using, again, guys, I'm just estimating a cup of milk to make this chocolate, and we use exactly 250 ml, a cup of milk, to make this chocolate. We're not wasting, we're using it efficiently. Our raw material cost per unit because we're being so efficient, we are not wasting, it will decrease. The cost will go down. So one of the possible reasons, as I've just explained, there could have been no wastage of raw materials, and it could have been used efficiently. The raw materials, in other words, no wastage, used efficiently. Right, let's move on now to your direct labor cost per unit. Okay, I'm just going to change the color of my pen there. Why did the direct labor cost per unit decrease as well? Direct labor obviously refers to your workers. So again, 51 Rand 70 cents, it has decreased to 37 Rand 38 cents. A possible reason for this decreasing, people, is that your workers are probably working very, very efficiently. They are not wasting any time. There could have been absolutely no overtime, and as a result of that, your direct labor cost per unit has decreased. So instead of the workers taking their 5-minute smoke break or walking around, they decide, okay, I'm coming to the factory, I'm coming here to make chocolates, so I'm not going to waste any time. I'm going to work during that 8 hours that I should be working. I'm going to work during that time. Right, so again, people, one of the reasons, and I know I'm repeating myself, but let's just say it one more time, direct labor cost per unit decreased due to workers being absolutely efficient in terms of the way that they are working, and there could have been absolutely no overtime. Okay, right, let's now look at the final unit cost, which is my factory overhead costs per unit. Again, people, if I inspect 2009, 2010, there's obviously been an increase in my factory overhead costs per unit. One of the reasons why this could have increased, remember, you had water and electricity that formed part of your factory overhead cost. We also had depreciation, and remember, we purchased an additional equipment or something additional in terms of the plant itself, and as a result of that, we had to provide additional depreciation. So that could have been one possible reason why this cost increased, or there was a rise in your factory overhead costs per unit. So let's write it down. Depreciation was provided for additional equipment. Okay, that could have been a possible reason. Another possible reason, guys, for this increase, your water and electricity. There could have been some kind of wastage in terms of water and electricity, leaving the factory lights on when there's no one working in the factory. That could have increased the water and electricity account, and as a result, your factory overhead cost per unit would have also increased. So there could have been wastage in terms of water and electricity, and that could have resulted in our factory overhead costs per unit increasing. Guys, another thing that we also need to consider in terms of our factory overhead costs per unit, in other words, why it increased, is, let's go to that point, the number of units produced. Now remember, people, if your number of units produced, like in this case, if it decreased or reduced, okay, so we were manufacturing 24,000 pairs of shoes, we've now manufactured 20,000. There's obviously been a drop in terms of the number of units produced. Every time your number of produced items reduces, drops, automatically our factory overhead costs per unit will go up, it will increase. So this is another factor, a third possible reason that we could consider or that we could use in terms of our answer. Right, people, we've come to the end of this question on the production cost statement. Remember, guys, the more you practice, the better your accounting results, the better you will do in this section of work. From myself, good luck for your prelims, good luck for your finals. Keep on practicing, people. God bless. Take care. Until we meet again, goodbye.